well. Thank you for having me back. It's always a pleasure.
I appreciate you staying up late to speak to us. Now, I'm going to get your reaction in a second. First of all, let's just remind ourselves what Jay Powell had to say last night. This is him speaking at the press conference, explaining the decision to cut.
So I would say today was a closer call, but we decided it was the right call because we thought it was the best decision to foster achievement of both of our goals, maximum employment and price stability. We see the risks as two-sided, moving too slowly and needlessly undermine economic activity in the labor market, or move too quickly and needlessly undermine our progress on inflation. So we're trying to steer between those two risks. And on balance, we decided to go ahead with a further cut.
Keith, how do you assess the Fed last night?
Well, it's a very, very interesting and complicated thing. I think the Fed telegraphed absolutely the wrong move, and when it acted, and particularly as you pointed out, changed its forecast, that's what really got the market's attention. And I don't believe it was a close call at all. I think that Chairman Powell, in fact, said we've got to cut, so he went ahead and did that, not realizing or deliberately ignoring the fact that rates have risen, mortgage rates have gone up, so certain areas of the economy are still very much an inflationary target. Others have relaxed considerably.
In terms of what we do for our portfolios, shares fell sharply last night, down about 3%. But I read your morning note, 5 with Fritz, saying, look, just ignore the noise, buy good companies with fortress balance sheets and strong growth potential. Tell us why you said that.
Well, history shows very clearly that stuff like this comes and goes. It shows that the markets tend to focus on great companies over time and have an upward bias because innovation attracts capital, Richard. So, the way I put it to our clients today after all this happened was, look, the markets are the only store on earth where customers fear a sale. And so what you've got to do on days like today is hold your nose. This does not change the business case for owning a company like Tesla or nvidia, where AI is playing into it. It does not change the case for owning an Apple or a Microsoft. This is a highly technical, liquidity-driven sell-off that is prompted purely by the remarks made by the Fed.
Well, let's look at some of the other themes that you're looking at the moment. And you led your note by talking about quantum computing. What is it and why are you so excited about it?
Well, quantum computing is a next step, both literally and figuratively, in terms of how we computerize. Quantum computing allows many solutions at once. Current computing standards are linear and progressive, so you have to go step by step by step by step. Quantum computing can do all of that at once. When that happens, we're going to see remarkable breakthroughs in computational speed, complexity of organizational problems that can be dealt with. The way we process information is going to potentially change human history. So imagine, for example, you're trying to cure cancer, or you're trying to solve money, you're trying to work on very, very, very complicated processes and procedures that are beyond current computational capacity. That's the kind of stuff that quantum computing is going to enable. And I think we're edging up to sort of a ChatGPT moment with regard to quantum computing.
What kind of companies do we buy? I know Google had a big announcement about quantum computing over the past few days.
Well, I think there's going to be any number of companies that are going to work on this, because people say, well, is quantum computing going to replace AI? Is it going to replace the need for companies like NVIDIA or AMD? And my answer is no. In fact, it's going to accelerate that, because quantum computing, my personal favorite, and full disclosure, I do own the company, IonQ, is the leader in platform-specific, big enterprise-level quantum computing. Massive computational skills, reduction in error, huge breakthrough onto the cloud already, real revenue. So that's why I like that company. But I'm also going to continue to hold the AMDs and the NVIDIAs of the world, because when it has all that data, it's like a trickle down. You've got to go to a menu, get some stuff on your plate, eat a little bit more, make another sandwich. I mean, that's just how it works with this kind of computing. It's hard to explain, but it really is a human, it's a breakthrough, Richard, in human history.
Your take on the Nissan Honda deal, if you will, Keith. Again, I loved your metaphor comparing it to 16th century Japanese history.
Yeah, it's getting a little bit off in the weeds, right? But having spent 35 years married to a Japanese, living in Kyoto at least part-time every year for all of that time, this is very much a pivotal moment in Japanese economic business history, because you have two companies that the West is trying to build as aligned because they want to remain competitive. No, they're aligned because they want to survive. And it leads up to a parallel in Japanese history in the 1600s, the Battle of Sekigahara. You had one weaker player ask a stronger player for an alliance. The stronger player then broke their promises and ruled Japan for the next 268 years. I think we're going to be lucky to see Honda and or Nissan survive this 10 years from now.
Can I ask you about the Dow, Keith? And partly the reason we've asked you to come on today was yesterday my co-host Tom and I were talking about the US markets, and Tom posed the question, why has the Dow had its worst losing streak since Jimmy Carter was president? And I'm going to bring Tom in now because that was yesterday. Today it's the longest losing streak since who?
Gerald Ford.
Tom,
1974. Oh, my goodness. Yes. So here's the thing. There's actually a very simple reason for this. The Dow is an equally weighted capitalized index, meaning that every component in the 30 that make it up is equally weighted. Now, the S&P 500 has 500 leading companies. It has been far quicker to adapt to the technological changes in our world today. The Dow, not so much. So what's happened is whereas all of three of the indices, the Dow, the S&P, and the NASDAQ tended to move together, now you see a break. The Dow is more security-like. It's slower to react to things. It's viewed as more of a safety play. So on days when the markets really takes a header, it's likely to be more stable. But today, of course, everything fell because nobody liked what the chairman had to say, but that's a different issue. But the real issue is simply the Dow is much more limited, does not portray the broader economy, much more conservative, has not adapted to reflect the technological change in our society in the last 20 years. The S&P 500 has.
and that's why you always say we should be picking individual stocks rather than just buying an index like the Dow if we want exposure to the US. Am I right in saying that?
Well, that's my view on it. And the reason I say that is because this is very much like buying cable television, right? You know, when you go to cable television, you have to buy everything just to get the one or two channels you actually want to watch. Now, history shows very specifically that individual companies, if you pick them correctly, do far better than the indices. So diversification, as we used to practice it, hasn't worked for about a decade, maybe even 15 years. I would submit the problem isn't diversification, it's the fact that people don't own enough of the right stocks, Richard. And so let me just explain briefly that. You know, if you're S&P 500, you've done 692% over the last, approximately 600 something percent over the past 20 years, but NVIDIA has done 20,000%. So if 600% is okay, great. But how are you going to answer the question when somebody says, well, you could have had 20,000%? You know, do you need more individual stocks or do you need less? I would submit the answer is more.
Keith, always great talking to you. Appreciate your time today. Thanks very much indeed for being with us. Keith Fitz-Gerald there is the principal of the Fitz-Gerald Group. Appreciate your time, not just today, but throughout this year, 2024. Merry Christmas and all the best for 2025, Keith.